What you're about to hear might sound impossible. Gold trading well above $4,000 an ounce, and yet we're calling this the last chance to buy under a certain threshold. But here's what the mainstream financial media isn't telling you. The technical setup we're seeing right now, combined with what's happening behind closed doors at central banks around the world, suggests we're not just in a bull market. We're at the precipice of something that only happens once or twice in a generation. A complete repricing of monetary metals that will leave most investors wondering how they missed the most obvious wealth transfer in modern history. Let me paint you a picture of what's actually happening right now. Gold has already shattered every previous record. We've blown past levels that analysts said were impossible just months ago. And yet, when you look at the underlying fundamentals, when you examine what the smart money is actually doing versus what they're saying publicly, you realize something profound. This isn't the end of the rally. This is the beginning of the acceleration phase. The part where prices don't just climb, they explode higher in a way that catches everyone off guard. Think about what happened when gold broke through $2,000. Everyone said it was overvalued. Then $3,000. Same story. Now we're trading above $4,000, and the chorus of skeptics is louder than ever. But here's what they're missing. Every single time gold has entered one of these parabolic phases throughout history, the final move higher has been the most dramatic. We're talking about gains that happen in weeks, not years. And the setup we're seeing right now has all the hallmarks of that final explosive leg. Before we go deeper, I want to make sure you have access to something that could be crucial for your financial future. I've put together a comprehensive guide that shows the exact strategies thousands of American retirees are using right now to protect their wealth from what's coming. It's completely free, and you'll find the link in the description below. This isn't theory. These are proven methods that are working right now, in real time, as the financial landscape shifts beneath our feet. Now, let's talk about what's really driving this market. The surface narrative is inflation, geopolitical tension, the usual suspects. But when you dig into the data, when you look at what's actually moving the needle, you discover something far more significant. We're witnessing the early stages of a fundamental restructuring of the global monetary system. And gold isn't just benefiting from uncertainty. It's being actively repositioned as the ultimate reserve asset by the very institutions that spent decades trying to diminish its importance. Central banks have been net buyers of gold for over a decade now, but the pace of accumulation has accelerated dramatically. We're not talking about modest additions to reserves. We're talking about aggressive, sustained buying that suggests these institutions know something the general public doesn't. When you see central banks in Asia, the Middle East, and even parts of Europe loading up on physical gold at these price levels, you have to ask yourself, what do they see coming that makes current prices look cheap? The answer lies in understanding the difference between paper wealth and real wealth. For decades, the global financial system has operated on a foundation of debt and derivatives, assets that exist primarily as entries in computer systems, promises to pay, backed by other promises to pay. It's a house of cards that's grown so large, so complex, that most people can't even comprehend the scale of the leverage involved. And gold, physical gold, represents the antithesis of that system. It's the one asset that isn't simultaneously someone else's liability. Here's where it gets interesting. The ratio of paper gold to physical gold has never been higher. For every ounce of actual metal that exists in vaults around the world, there are dozens, maybe hundreds of claims on that same ounce through futures contracts, ETFs, and various derivative products. This works fine as long as everyone's content to trade paper. But what happens when a critical mass of investors decides they want the real thing? What happens when the music stops and everyone rushes for the exit at the same time? We're starting to see the early tremors of exactly that scenario. Physical premiums are rising. Delivery delays are extending. The spread between paper prices and physical prices is widening in certain markets. These are the warning signs that the paper gold market, which has effectively suppressed prices for years through sheer volume of trading, might be losing its grip. And when that dam breaks, when the price of paper gold has to converge with the reality of physical scarcity, we're going to see a repricing that makes current levels look quaint. Let me give you a specific example of how this plays out. Look at what happened in the silver market back when the Hunt brothers tried to corner it. Now, I'm not suggesting anyone should try to corner a market. That's illegal and foolish. But what that episode demonstrated was how quickly prices can explode when physical demand overwhelms paper supply. Silver went from single digits to nearly $50 in a matter of months. not because of inflation, not because of industrial demand, but because the paper market couldn't deliver against the contracts that had been written. Gold is in a similar setup right now, except the scale is exponentially larger, and the players involved are nation-states, not individual speculators. The technical picture reinforces this fundamental story. Gold has broken out of every major resistance level. We've cleared patterns that took years to form. The moving averages are all aligned in the most bullish configuration possible. And here's the key detail that most technical analysts are missing. The breakout happened on massive volume with strong momentum. This isn't a weak rally that's going to fade. This is institutional accumulation disguised as a breakout. The smart money isn't waiting for a pullback. They're buying aggressively at current levels because they understand what's coming next. Volume analysis tells us something crucial about market psychology. When gold was trading at lower levels, volume was relatively light. Retail investors were skeptical. Institutional players were cautious. But as we've pushed higher, volume has exploded. That's not distribution. That's not weak hands buying the top. That's strong hands accumulating with urgency. And when you see that kind of volume profile combined with price strength, history tells us the move is just getting started. Now let's talk about the elephant in the room, the dollar. For decades, the dollar's strength has been inversely correlated with gold prices. When the dollar rallies, gold typically falls, and vice versa. But something strange has been happening lately. Gold has been rising, even as the dollar maintains relative strength against other fiat currencies. That's not supposed to happen according to traditional models. So what's changed? The answer is that investors are starting to question the long-term viability of all fiat currencies, not just the weak ones. When gold rises alongside the dollar, it's telling you that the market is losing faith in the entire system of paper money. It's not about which currency is least bad anymore. It's about whether any currency can maintain purchasing power in an environment of unlimited money printing, escalating debt levels, and political instability. And the answer that more and more investors are arriving at is no. Think about the debt situation for a moment. Global debt levels are at all-time highs. Government debt, corporate debt, consumer debt. It's everywhere, and it's growing faster than the underlying economies can support. At some point, this debt either has to be paid back, defaulted on, or inflated away. Those are the only three options, and history shows us that governments always choose inflation when given the choice. It's the politically expedient path. It's the way to reduce the real burden of debt without the immediate pain of default or the political suicide of austerity. But here's what makes this cycle different from previous ones. The amount of debt is so large that traditional inflation won't be enough. We're not talking about 3, 4, 5% inflation that slowly erodes purchasing power over decades. We're talking about the potential for a much more dramatic devaluation of currency relative to real assets. And when that happens, when the market loses confidence in the ability of central banks to control inflation without destroying the economy, gold doesn't just go up, it goes parabolic. Let me tell you about something that happened in the late 70s that most people have forgotten. Gold went from $35 an ounce in the early 70s to over $800 by 1980. That's not a 20% gain. That's not even a 100% gain. That's a 20-fold increase in less than a decade. And it happened because investors lost faith in the dollar's ability to maintain value. The circumstances that led to that move, high inflation, geopolitical tension, loss of confidence in government policy, are all present again today. Except now, the imbalances are far larger, and the potential for disruption is far greater. Here's something else to consider. The mining supply of gold is essentially flat. Despite higher prices, despite improved technology, despite massive exploration efforts, the amount of new gold coming out of the ground each year isn't increasing. In fact, many of the world's largest gold mines are in decline. Production is falling at existing operations, and new discoveries aren't replacing depleted reserves. This means that any increase in demand has to be met by higher prices, not increased supply. It's basic economics, but the implications are profound. And demand is increasing from every direction. Central banks are buying. Institutional investors are allocating. Retail investors in Asia are accumulating. Even younger investors who grew up in the digital age are starting to recognize that physical gold offers something that Bitcoin and other cryptocurrencies can't. Tangible, proven, universally accepted value that doesn't depend on electricity, internet access, or the continued functioning of complex technological systems. Speaking of which, let's address the digital gold narrative for a moment. I'm not here to bash cryptocurrencies. They have their place, and they've created enormous wealth for early adopters. But the idea that Bitcoin or any other cryptocurrency can replace gold as the ultimate store of value is fundamentally flawed. Gold has been money for 5,000 years. It's survived the collapse of empires, the rise and fall of currencies, wars, depressions, and every other crisis humanity has faced. Cryptocurrencies have been around for 15 years. They're an experiment, and while that experiment might succeed, it might also fail in ways we can't predict. Gold doesn't have counterparty risk. It doesn't depend on miners validating transactions. It doesn't require a functioning power grid or internet infrastructure. It just is. And in a world that's becoming increasingly unstable, increasingly complex, increasingly dependent on systems that could fail, that simplicity and reliability is worth something. It's worth a lot, actually. And the market is starting to price that in. Now, I want to take a brief moment to talk about something that's relevant. If you're thinking about retirement security, if you have $100,000 or more in retirement accounts, there's a strategy that more and more Americans are using to protect their wealth from what we've been discussing. It's called a gold IRA, and it allows you to hold physical gold inside your retirement account without triggering taxes or penalties. I've put together a detailed guide that explains exactly how this works, what the benefits are, and what you need to know before making any decisions. You'll find that in the description below. It's worth looking into, especially given where we are in this cycle. But let's get back to the market analysis. The geopolitical situation is another factor that's not getting enough attention. We're seeing a fundamental realignment of global power structures. The post-World War II order that's been in place for nearly 80 years is breaking down. New alliances are forming. Old alliances are fracturing. And in the middle of all this chaos, countries are looking for ways to conduct trade, store wealth, and maintain sovereignty without being dependent on a system dominated by any single nation. Gold is emerging as the neutral asset in this new world order. It's not American, it's not Chinese, it's not European, it's universal. And that universality makes it the perfect medium for international settlement in a multipolar world. We're already seeing this play out in various ways. Countries are settling oil trades in currencies other than dollars, backed by gold. Central banks are repatriating their gold reserves from foreign vaults. New gold-backed financial instruments are being developed to facilitate trade outside the traditional dollar system. This isn't conspiracy theory, this is documented fact. The BRICS nations have been openly discussing the creation of a new reserve currency backed by a basket of commodities, with gold playing a central role. Whether that specific initiative succeeds or not is almost irrelevant. The fact that it's being discussed, the fact that major economies are actively working to reduce their dependence on the dollar, tells you everything you need to know about where this is heading. And as the dollar's role as the global reserve currency diminishes, even slightly, the demand for gold as an alternative reserve asset will increase dramatically. Let's talk about what this means for price targets. Major investment banks are now publishing research with targets that would have been laughed at just a few years ago. $5,000, $6,000. Some are even suggesting that $10,000 per ounce is possible within the next few years. These aren't fringe analysts. These are mainstream institutions with billions of dollars under management. And they're telling their clients to increase gold exposure at current levels. But here's what's really interesting. Even those aggressive targets might be conservative. They're based on models that assume the current system remains largely intact. They assume that central banks will be able to manage inflation without triggering a crisis. They assume that geopolitical tensions will remain contained. They assume that the paper gold market will continue to function normally. But what if one or more of those assumptions proves wrong? What if we get a real crisis? Not just elevated uncertainty, but an actual breakdown in the financial system. History provides some guidance here. In every major monetary crisis, gold has repriced dramatically higher relative to currency. Not 20% higher, not 50% higher. We're talking multiples. In Weimar Germany, gold went from being worth a certain amount of marks to being worth essentially infinite marks as the currency collapsed. In Zimbabwe, the same thing happened. Even in more stable economies during times of crisis, gold has shown the ability to appreciate far beyond what conventional models predict. I'm not saying we're headed for hyperinflation or currency collapse, but I am saying that the risk of such outcomes is higher than most people realize. And even a small probability of a catastrophic outcome should factor into your wealth protection strategy. This is basic risk management. You don't buy insurance because you expect your house to burn down. You buy it because the cost of being wrong is too high to ignore. The opportunity cost of not owning gold right now is significant. If gold continues its current trajectory, if we see the kind of acceleration that the technical and fundamental setup suggests is possible, being underexposed or not exposed at all could be one of the most expensive mistakes of your financial life. And unlike many investments where you can always buy in later, gold has a tendency to gap higher in ways that make it difficult to establish positions once the real move begins. Think about it this way. When gold was trading at $2,000, people said it was too expensive. They waited for a pullback that never came. When it hit $3,000, same story. Now we're well above $4,000, and the same people are still waiting. At what point do you accept that the pullback you're waiting for might not happen? At what point do you recognize that the market is telling you something important, and that fighting the trend is costing you money? The smart money isn't waiting. They're accumulating. They're building positions. They're preparing for what comes next. And what comes next, based on every indicator we can measure, is a continuation and likely acceleration of the current trend. The breakout we've seen isn't the end of the move. It's the beginning of the final phase. The phase where prices move so fast that it feels uncomfortable, where gains happen in days that used to take months, where the market leaves behind anyone who's not already positioned. Let me share something that might help put this in perspective. In every major bull market, there's a point where the majority of the gains happen in a compressed time frame. The stock market in the late 90s, real estate in the mid-2000s, Bitcoin in 2017, and again in 2021. The pattern is always the same. A long accumulation phase where prices grind higher and most people remain skeptical. Then a breakout that gets everyone's attention. And finally, a parabolic phase where prices go vertical and everyone who was skeptical suddenly becomes a believer. Gold is transitioning from the breakout phase to the parabolic phase right now. The accumulation happened over the past few years while everyone was focused on stocks and crypto. The breakout happened when we cleared the previous all-time highs and kept going. And now we're entering the phase where the real money is made. The phase where fortunes are built. The phase where being positioned correctly can change your financial life. But here's the thing about parabolic moves. They don't last forever. They're intense, they're dramatic, and they end suddenly. The key is to be positioned before the parabola begins, not after. Once everyone recognizes what's happening, once gold is on the front page of every newspaper and the lead story on every financial news channel, the easy money has already been made. You want to be the person who bought when it was still controversial, not the person who bought when it became obvious. The technical indicators are all pointing in the same direction. The RSI is strong but not overbought. The MACD is bullish and accelerating. The volume profile shows institutional accumulation. The moving averages are perfectly aligned. Every single technical tool we have is saying the same thing. This trend has room to run. This move is not exhausted. This is not the time to be cautious or wait for better entry points. And the fundamental picture reinforces the technical story. Supply is constrained. Demand is increasing. Central banks are buying. Geopolitical tensions are rising. Debt levels are unsustainable. Inflation is proving more persistent than central banks expected. Currency debasement is accelerating. Every single fundamental driver that supports higher gold prices is not only present but intensifying. Think about what happens when these forces converge. When technical momentum meets fundamental strength. When institutional buying meets retail FOMO. When supply constraints meet surging demand. When paper markets meet physical reality. The result is a price move that exceeds everyone's expectations. A move that makes current levels look cheap in retrospect. A move that creates generational wealth for those who positioned correctly. The mining stocks are starting to reflect this reality. Junior miners are beginning to outperform. Mid-tier producers are showing strength. Even the major producers, which typically lag in the early stages of a gold bull market, are starting to participate. This is important because mining stocks are leverage plays on gold prices. When gold moves, mining stocks typically move 2 to 3 times as much. And we're seeing that leverage start to kick in now. But physical gold remains the foundation, the core holding, the asset that provides true wealth preservation without counterparty risk. Mining stocks are great for speculation and leverage, but physical gold is what you own for protection, for insurance, for the peace of mind that comes from knowing you have real wealth that can't be printed, debased, or confiscated through inflation. The delivery situation in physical markets is getting tighter. Premiums are rising. Wait times are extending. Dealers are reporting strong demand and limited supply. This is exactly what you'd expect to see in the early stages of a physical shortage. And if that shortage develops into something more serious, if we reach a point where paper prices and physical prices diverge significantly, the repricing will be swift and dramatic. I want you to imagine something for a moment. Imagine waking up one morning to news that a major financial institution has defaulted on its gold delivery obligations, that the paper gold market, which has functioned smoothly for decades, has suddenly seized up because there's not enough physical metal to satisfy all the claims. What do you think happens to the price of gold in that scenario? What do you think happens to the value of physical gold you already own versus paper gold that might not be deliverable? This isn't fear-mongering. This is risk assessment. The paper gold market has always operated on the assumption that only a small percentage of holders will ever demand physical delivery. But what happens when that assumption breaks down? What happens when a critical mass of investors loses faith in paper claims and demands the real thing? The system isn't designed to handle that scenario. And when systems encounter scenarios they're not designed to handle, they break. The opportunity we have right now is to position before that potential break occurs. To own physical gold while it's still readily available at prices that, in hindsight, will look incredibly cheap. To be on the right side of what could be the most significant wealth transfer of our generation. Because make no mistake, when gold reprices dramatically higher, wealth doesn't disappear. It transfers from those who held paper assets to those who held real assets, from those who trusted the system to those who prepared for the system to fail. Every major wealth transfer in history has followed the same pattern. The majority, comfortable with the status quo, refuses to see the warning signs until it's too late. A minority, paying attention to what's actually happening rather than what they're told is happening, positions accordingly. And when the transfer occurs, when the old system breaks and the new reality emerges, that minority finds themselves dramatically wealthier while the majority wonders what happened. You have a choice to make. You can listen to the mainstream narrative that says gold is overvalued, that the rally is overdone, that you should wait for a pullback, or you can look at the actual data, the actual behavior of smart money, the actual setup of the market, and recognize that we're in the early stages of something historic. The choice is yours, but the window for making that choice is narrowing. The title of this video talks about a last chance. That might sound hyperbolic, but consider what happens if gold continues its current trajectory. If we see $5,000, $6,000, $7,000 per ounce in the coming months. At what point does it become prohibitively expensive for average investors to build meaningful positions? At what point does the opportunity shift from wealth building to wealth preservation? We're approaching that inflection point. We might already be there. For those of you who've watched this far, who've taken the time to understand what's really happening in the gold market, I want to make sure you have access to the resources that can help you take action. That free guide I mentioned earlier, the one in the description, it's comprehensive. It covers everything from the basics of gold ownership to advanced strategies for retirement accounts. And for those of you with substantial retirement savings, $100,000 or more in any retirement account, I'm offering something special. An exclusive one-on-one educational web conference, completely free, no obligation, where we can discuss your specific situation and how gold might fit into your wealth protection strategy. This is only available to American retirees who mention they watch this video to the end. The details are in the description. The bottom line is this: gold is not overvalued at current levels. It's undervalued relative to where it's going. The technical setup is bullish. The fundamental drivers are intensifying. The smart money is accumulating. And the window for positioning at what will, in retrospect, be considered cheap prices is closing. This isn't about timing the perfect entry. This isn't about catching the exact bottom. This is about recognizing a major trend in its early stages and positioning accordingly before the real move begins. History will look back at this period as a pivotal moment, a time when the global monetary system underwent fundamental change, a time when gold reasserted itself as the ultimate store of value, a time when those who understood what was happening and acted accordingly built significant wealth. The question is, will you be part of that group, or will you be part of the majority who recognized the opportunity only after it had passed? The choice, as always, is yours, but the time to make that choice is now.